Riley, thank you so much for joining me, mate. There's been a lot going on in the budget, right? There's a lot of different ideas, a lot of different opinions, and I just wanted to touch base with yourself and ask you a couple of questions, if that's okay.
Yeah, absolutely. It's fine. There's a lot to talk about. Still a lot that we will have to talk about in July and the coming sort of months in the new financial year. But happy to chat about a draft proposal.
Awesome. So, mate, I guess first cab off the rank, what has changed in how you're structuring client portfolios post budget? There's a bit of ambiguity about how this is all being executed. We'll obviously got to go through Parliament, but what are your first reactions to that?
Yeah, well, the first reaction for a lot of people is don't panic. A lot of people move straight into panic mode from Tuesday night. And I know for my calendar personally, it just went straight away to boom, completely full. Everybody wants to chat. The first thing I'm thinking for pretty much everybody is nothing is law yet. And this government and plenty of governments of the past have a history of backtracking on things, overdoing or overcooking certain proposals, and then getting second opinions, and the debate, you know what I mean, picks up from that point
Yeah.
and they backtrack. So it is worth saying to anybody that's tuning in here, as well as my clients, don't panic over a proposal. There's still plenty of time for us to think about what the next steps are. In saying that, though, for my clients in particular who may have been on that journey where they wanted to purchase an investment property, um, I am telling a lot of people just to sit and wait. And that also goes for people with considering things like family trusts. But overall, one thing for us to be aware of is that really outside of the family trust realm, just to keep it property focused, the government is trying to really hit residential property with a sledgehammer. But there are certain areas that are completely unaffected. You know what I mean? Shares, superannuation for the most part, commercial property even. So people that have already diversified or are looking to diversify, they will be far better off than somebody whose entire strategy was property, 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 like a rent fester.
Awesome. So, it's something I think that's really looming large in my mind, and similar to what you just said, the ways that we invest and the how we invest and the different assets we invest into, is that going to make it easier for your job to help people diversify from here on, because it is limited slightly as to the overall, carrot that's hanging for a lot of property investors?
Yeah, it's a little bit frustrating because in previous years I've had a really good network of people around me that were in the property space where they had clients that were either starting their journey or in the middle of their journey. This is property journey, that is, and they needed advice because they didn't know what to do next. Unfortunately, the way I'm looking at the budget, if everything gets through at the moment, is there's just a few sort of tools in my toolbox that are now gone. So some of the
Mm.
structures like family trusts and bucket companies completely gone. For a lot of people that were on the fence of being able to afford an investment property or two and take advantage of that leverage, but between borrowing capacities potentially dropping and just overall cash needed to keep that property afloat for 20 years, it is becoming harder, which I think is a bad thing. It's a good thing for financial advisors because there's going to be a lot of people that need advice. But I do think it is a bad thing because it means that it's a bit hard to, for lack of a better term, separate the men from the boys with financial advisors, given that we have all got maybe three or four tools in the toolbox now. Some of the ones that were more educated on certain structures and willing to collaborate with accountants on what the next best step is. For the short term, at least, that's sort of been hit with a sledgehammer. But if this law gets through, it might take us 3 months, 6 months, a couple of years. Um, but there will be another loophole that comes in, or another, not necessarily loophole, another optimal strategy for the vast majority of people.
Awesome. One of the things that I've been wondering with the CGT changes that are coming through, if the discount decreases, it all passes through with the budget. Does P&I start to become more attractive over time than I think the optimization of interest only has kind of been looked at the last few years?
Yeah, it's a good question to be honest. And it could go either way. With somebody that's purchasing an established property, for example, that cannot get the negative gearing benefits, principal and interest may become more compelling because that loan isn't deductible. So under the old rules, with negative gearing, you'd keep that investment debt interest only, have lower repayments, then allocate that surplus cash flow to your non-deductible family home or to shares or super or whatever, or to your next property. Now that the current property you're buying is not going to get any negative gearing benefits, then having an interest only loan is sort of less attractive there. So it does need a better justification compared to years of the past where people were pretty much just going interest only, interest only, interest only. If somebody that's trying to create equity and wealth over the next 20 years, then um, if their family home is paid off, for example, yeah, they may go and look at a principal and interest repayment structure on the investment property. Um, but one thing that you would know better than me is that, from what I'm hearing on the ground, is that people's borrowing capacities already have reduced and could even reduce further. And then, given there's no negative gearing, which is obviously helps people hold a property because they're getting the tax benefits through either a PAYG variation or at the end of a financial year. Now that it's going to cost up to 50% more to hold the same property, if you're now also going from interest only to P&I, which is higher repayments, it does mean that affordability considerations become more and more and more important than what they previously were.
Yeah. The look, borrowing capacity has dropped drastically over the last 10 years. Uh, when I was first becoming a lender and learning what I do, we would easily able to upgrade people, get them to a next home, work through that process. And these days, with things like repayment loadings, assessment rates changing over time, household expenditure measure, so HEM, which is a big thing, increasing with the cost of living, it's become harder and harder. And I think a lot of people are in a higher tax bracket with higher, tax, which hits which hits your taxable income on the back end and servicing and everything. So it's this really perfect storm over the last 10 years, probably 8 years post Royal Commission, that we've seen borrowing capacity just tighten and tighten and tighten. And I think we'll chat to an accountant about this later today, but I think structures and everything is going to be more important to really learn more about as the average investor. But with all these changes, can you just walk us through why the numbers still make sense to have exposure to residential property investing?
Yeah, well, it really depends on where you're at in your journey. And you touched upon there with structuring. Structuring is really, really important because it's going to relate to how much you actually get to keep at the end of your journey. If you consider your structuring before you go out there and invest, that's going to be, extremely important because it's not about how many properties you own or anything like that. It's how much wealth are you actually creating in after tax dollars that you will get to retire early with or retire with or pass to the next generation. So I look forward to listening in with the accountant because the structuring part's going to be fantastic and a lot has changed there. But in terms
I'll
of,
give you a hint. She's very on the fence about everything.
yeah,
She's an accountant.
people are, and it's really for everybody listening in. It's just a wait and see game. We don't know what's going
Yeah.
to get approved. If things get approved as they currently are, company structures could become for some people a more attractive option, less flexibility, but at least it has a maximum tax rate of 30%. Trusts now have a minimum tax rate of 30%. So something will change there. Now, I do apologise, Alex. You asked me a question, and as always, I go off topic, so you might need to restart the original one.
You and me both, mate. Why do the numbers still work for residential property investing?
Yeah, well, look, at the end of the day, it's about taking that long term view. Like, I'm not here to say we need to throw the baby out with the bathwater and never invest in property again because of a budget proposal that could very well be overturned at the next election, or may not even get through as it currently stands in a couple of months' time. So, assuming people are happy to sit tight, right, and figure out what the rules of the game are, as a long-term asset, it is still a fantastic asset. So if you can't access negative gearing, absolutely, it just means that you need to wait and see what you can afford. Um, but overall, if we are still getting a total return of, let's say, 7% to 11%. That's total return. And if the vast majority of that is capital growth, which in my opinion is the way we want to invest, obviously under the new indexation rules, we're going to be paying a little bit more tax, but you're only paying tax if you're making money, right?
Mm.
As part of most people's wealth creation journey, we've got the four pillars of wealth. One of those pillars is utilizing leverage, right? And the power of leverage. And there's two really good ways to use leverage. First one is property. The second one is to potentially debt recycle into shares. And shares isn't for everyone because it has a lot more volatility than property. So overall, property, bricks and mortar it's been around for a very long time. It's still going to be around into the future. People just need to think about, can I afford this first and foremost, under the new rules? And is it, I think above everything, is it an investment grade asset? Because it's today, if the new rules get passed, it's less about getting property, and more about, with your finite amount of surplus cash flow, what is the best quality asset that I can get at this point in time? Because that's what's actually going to leave you with the after-tax dollars one day when you sell.
Awesome. And I think that's a really key thing to keep in mind is the government tries to take negative gearing away from existing properties, focus on new builds property to fix the housing supply issue that we've got, that we still need to make sure we're getting good assets.
That's exactly right. And when we look at supply and demand, for me personally, just as a disclosure, I'm not going to be investing in new builds. There are plenty of areas where they do build new houses and it's in a landlocked area and they will do perfectly well over a long period of time. But in my experience, a lot of new build areas, it is for the foreseeable future, a substantial increase in supply because they're building more and more and more houses. And if demand stays the same and supply rises, then the price isn't going to rise as well. So we invest our money for capital growth, not income, in my opinion. And that's how we're going to make the most amount of our money in property and whatever asset through capital growth. So for me personally, I think it just rams home for a lot of people. What is the order of my financial lifestyle, like the life I'm trying to create? And I think it just takes it back to fundamentals. For a lot of people that may have been on a rent vesting strategy, maybe we need to bring the family home forward if we can. It is easier said than done. If you live in Bondi or North Sydney, it's going to be pretty tough. But really, it just, for me, family home first, leverage second, whether that's shares or property. And then super's still unchanged from 1 July up to $2.1 million per person if you're retiring, is the general transfer balance cap, which is the amount you can have tax-free. If you don't plan on retiring pre-60 and you love your job, that's a very, very attractive structure for some surplus cash if you have it.
Awesome. Mate, I won't keep you long because you've got to run. You're a busy man. What have you got to say to people who are a little bit spooked out of investing into property at the moment?
Yeah, great question. I've got a lot to say, to be honest, but I would just say be patient and then just look at your own situation objectively. Take emotion out of it. If you already own the properties before budget night and you run the numbers, or you get advice for someone else to run the numbers like we do for our clients, you already have access to, you know what I mean, the negative gearing, which is grandfathered. You probably just need to think about what sort of asset you hold and how that's going to be changed from a tax calculation perspective from 1 July 27. I think a lot of people are going to need to get valuations leading up to that. But do you already own property, or are you starting your journey now and you're thinking you're going to own property? If you are only starting your journey now and you own the family home, then it could still be a fantastic avenue. If you were thinking about going down a rent vesting path, unfortunately, it's a lot less attractive than what it was. But the second thing is just ask yourself deep down, was I investing because I heard something on a podcast or I was following a book or whatever it may be? Because a lot of these resources were recorded, drafted, written under the old rules. And you just need to think about how do these things slightly change? Get yourself advice, and when you're thinking about investing, make sure that we're buying assets that are investment grade. We're not buying assets for tax benefits. We're buying a long-term set and forget asset for 20 years.
Awesome. I love that because I think from my perspective, and you know, I love cash flow, right? I'm a nerd when it comes to that sort of thing. Most of the people, I would say all the clients that I work with I know they can afford the gross payments prior to any negative gearing kicking in. It's really been part of the servicing assessment allows for that. You get that's negative gearing once a year, generally speaking, unless you opt in to pay cycle. But I think a lot of people have the affordability still if sometimes the serviceability doesn't appear. And I'll be really interested to see what accountants, financial advisors like yourself and banks do to make sure that people can still enter the market and invest in. I think personally, I'm looking at going, well, what actually changes in my world when it comes to my income, my wife's income, my household's expenses? It's generally not that much when these giant world events happen, like fuel prices. I drove V8 and I didn't feel it. So if I'm not feeling it, we're all fine. That's my opinion. I'll stick by it. But mate, thank you so much for joining me today. I really appreciate your time. We're going to move on to the next person.
Thank you, mate. Thanks for having me.
What Riley just said, it was incredible. Don't panic. Nothing is law yet. And who knows better than someone with a law degree?